Good afternoon and welcome, everyone. Welcome to a webinar today that I think is very, very important. One of the things that I've realized as a business owner is that, numbers are really, really important. And the reason they're really important because they tell us, how our business is doing. And for a lot of us, this time of the year, well, in my case anyway, is quite stressful because it's our year end. Accountants are asking for information, they're producing financial statements, all of these type of things. So it's quite a stressful time of the year, but it's a time where I think the more we understand about financial statements, the better it is for us, because then we can understand, firstly, the financial statements that our accountant has produced for us, and more importantly, what it means for us, what it means for our business, or what it means for the success of our business. For those of you that haven't met me before, my name is Andrew Patricio, and I've always been a business owner. But for the last 25 or so years, I've been educating, training, and trying to inspire business owners in different parts of the world, mainly in Canada, but in different parts of the world. And it's very, very interesting that this is one of the biggest challenges that small business owners face. It's really managing the financials in their business, managing the money in their business, trying to determine, are they charging a fair price for their product or service? Are they making a profit? Will they survive? All of these things are key challenges that we go through. And, I was having a discussion with a business owner yesterday, and he was talking about his financials. And one of the biggest challenges small businesses have is finding somebody, an accountant, that can work with them. And he was saying, well, his accountant's left now, and it's a problem because he has to find a new one. His accountant was bought out. And I said to him, the financials in a small business are not that complicated. It's really about understanding what your revenue was last year, understanding what your cost of sales were last year. And to calculate your cost of sales, you have your opening inventory plus the purchases that you made of inventory minus your closing inventory and the expenses you generate. And that'll tell you how much profit. And it sounds very, very simple when I explain it like that. But the truth is, you as a business owner need to have a basic understanding of these financial statements, because then they'll help you have the information ready when your accountant requests it. And then also, it'll help you analyze these financial statements at the end of the year. So when your accountants produced your financial statement, one of the things you should be doing is going back and analyzing and seeing, how did we do? And so today I'm going to share with you some really important information. And I'm going to try and keep it as simple as possible. And the reason I'm going to try and keep it as simple as possible is that once you understand these basics, once you understand them, it really helps. It doesn't make you an accountant, or doesn't ensure that you can create your own financial statements, but it makes it easier for you to run your business more effectively. And I think this is a really, really important part of building a successful business. So let us start off by discussing the first two financial statements. So basically in your business, you're going to deal with three different things. Firstly, it's going to be your income statement, which your accountant's going to produce at the end of the year. There's your balance sheet that your accountant's going to produce at the end of the year to submit to the revenue agency. And the third one is going to be your cash flow. Okay. One is your main responsibility, which is cash flow, and the other two, typically your accountant would do for you. And I encourage you to get an accountant to do it for you. It doesn't matter how smart you are, how educated you are. I think it's really, really important that you as a business owner understand the basics, but get somebody to do it for you, because this is their experience. They have this knowledge. They understand how the revenue agency wants these financial statements. They can analyze them for you. All of these things are really important. But let us start off by discussing the first financial statement. And some of you will, I'm sure, know exactly what I'm talking about, but just in case, sometimes we call the income statement the profit and loss statement. So basically it's saying to you, at the end of the year, how much revenue did we generate? What were our expenses? And very, very importantly, did we make a profit or a loss? Okay, so this document is really important. If you really want to understand how do you measure, how did I do last year, your best way of doing that is doing an income statement, because it's almost like a report card for your business. So last year, this is how much revenue we generated. These were our cost of sales for the product that we purchased and sold. And these were our expenses. And based on that, we can evaluate your business, or I could even evaluate your business. Even though I'm not an accountant, if you gave me your income statement and just gave me a bit of background on what your business is, I could tell you what you're doing wrong and what you need to do to improve, even though I'm not an accountant. And this is why I want you to understand that not only do you have to, by law, submit an income statement to the revenue agency, but it's a good idea to understand what the numbers are, because they're not just numbers. They're numbers that you have given to your accountant, or your bookkeeper or somebody else has entered into your accounting system, and then they take these numbers and they put them together in a statement that's really easy to understand. So it measures the performance of your business. If you use an accounting system, which a lot of small business owners use, if you're using something like QuickBooks or Xero or Wave, or there's so many different ones, and I'm not recommending you use one or the other, but if you use those, it's really helpful, because at the end of every month, let's say, for example, I said to you, so how was business last month? You could just click one button and it'll produce an income statement for last month. If I'd ask you, how did you do last year? You could just click one button, as long as you enter the information properly. Just click one button and you could tell how much revenue you did last year. So you could do it for a month. You could do it quarterly, like companies listed on the stock exchange do. But by law, you have to do it at least annually so that you can submit it to the revenue agency. If you're a sole proprietor, they're going to calculate your income taxes based on that. If you're a corporation, they're going to calculate your corporation taxes based on that. So it's really important that you do it, and it's really important that you do it on time, I think, is also an important thing. I always try and get mine in before everyone else so that my accountant has time to be able to do my financials properly. The income statement is a record of all the income you generated last year and all the expenditure. And income comes from mainly from selling stuff, so products and services, but also if you, for example, sold certain assets in your business, that could also be income. So all of that information needs to go into your income statement, and your accountant will know exactly how to put that in, the structure to put it in, the format that the revenue agency wants, they would know how to do that. And then it tells you how much of a profit or loss your business has made. And this is a really important thing, because as a business owner, obviously, we always want to make a profit. But there are certain years that you're going to make a profit and certain years that you're not going to make profit. We've been in business for 20 years, and we have good years and we have bad years. As long as when we don't make a profit, we know the reason. And sometimes there's very, very good reasons why we don't make a profit. It's understanding that. What really concerns me when a small business owner is not making a profit and has no idea why. And that creates anxiety for me, because there are ways of understanding where your issues are by producing an income statement. The other thing that I think is quite an important thing, and I didn't come up with the saying, but there's a saying out there that sales is vanity and profitability is sanity in small business. And then the third part of it is cash flow is reality. But I think this is a really, really important thing to understand as a business owner. I know when I first started in my first business, I was obsessed with generating revenue. That was my big thing. if we can do high sales, we'll be okay. And if any of you have been exposed to the tech industry, that's really what you want to go after. They base the value of your company on the revenue you generate. But as I became more experienced as a business owner, I realized very, very quickly, even though sales is important in a business, being a profitable business, I think is just as important. So I want you to understand that is that your objective as a business owner is to make a profit. And you must never forget that, because your ego wants great sales. That's what it wants. It wants good sales, wants revenue. People will speak about, we do $1 million a year, or I was looking on somebody's revenue resume the other day. I run a 6-figure business, a 7-figure business. So people are quite obsessed with sales, and it's important, but you got to make a profit, and you must never forget that, and never apologize for being a profitable business. And understanding, for example, why you're not profitable is really a key thing. I was speaking to a business owner yesterday, for example, and she was saying to me, that year before last, she did $30,000 of revenue. Last year, she did $20,000 of revenue, and she really needs to get that number up. And I was saying to her, if I was you, I would set myself a target of, say, $100,000. Okay. I said, because then you've got something that you're working to. You've got a direction that you're working to. So even if you don't achieve the $100,000, even if you achieve 90 or 80, you will break even. And I want you to understand the importance of setting yourself sales targets as a business owner, understanding how much revenue you need to generate, and then working to achieve that number. Because it's really key that you understand these are the basics of business. They are really the basics of business. But I realize on a daily basis, working with business owners, even though these are the basics of business, a lot of us get it wrong. We focus on running the business, we focus on generating revenue, we focus on marketing, we try and ignore the numbers, hoping by some divine intervention, they'll go away. And the reality is they never go away. They're important to analyze, important to know, and you've got to be setting yourself targets all the time. So what I'm going to do now, firstly, I'm going to turn off my camera so I can work on an income statement for you. And I'm going to show you exactly what an income statement looks like. Okay. And I'm going to keep it really simple. So keep that in mind. Everything I do today, the objective is to keep it really simple so that you get a basic understanding. Okay. Also, I want you to understand that when you go to your accountant, if he or she produces one like this for you, maybe a little bit different, okay? But the basics are the same always, okay? So let's use an example. I'm going to use a retail example. So if you're a Main Street retail store, this is what it would look like. You'd have revenue, let's say last year, you did 126,000, let's make it a little bit higher. You did $287,500 of revenue. Let's say your cost of sales, and I'm going to tell you how you get that cost of sales number now. So let's say your cost of sales was 115,451. Okay. So let me explain to you how you get that cost of sales number. So the revenue is everything that you sold last year. So that's your Z readings. If you're a retail business, if you're a service business and you issue invoices, it's a sum of all the invoices that you issued last year, okay? And these are excluding HST for those of you in Ontario. So that's your revenue. The second one is your cost of sales. So your cost of sales is your opening inventory, okay, which is really important. Your opening inventory plus your purchases of inventory and your closing inventory. So let's use a very simple example. Let's say I sold bottles of water, okay? I had 100 bottles of water at the beginning of the year. So on the 1st of January or the 31st of December, at the end of the day, I had 100 bottles of water, okay? I purchased 500. So I had 100, I purchased 500, that makes it 600, okay? And if I've got 200 left, my cost of sales will be 400, okay? So it's opening inventory of 100. I purchased 500, that makes it 600, less 200 that I have left over, that makes my cost of sales 400. Okay, so it's really important that you understand this, because your accountant, if you got inventory in your business, is going to ask you to take stock at the end of the year. And the reason they ask you to do that is so that they can accurately do your income statement. If you don't give them accurate numbers, well, you know what, your income statement is not going to be accurate. Also, these numbers are at cost. Revenue is regularly as it is. Your inventory, your cost of sales is at cost. So understand that. That'll give you your gross profit margin. So if you ever hear people talking about gross profit or gross profit margin, or sometimes we used to use the acronym GP, or what's another accounting term they use is gross contribution. These are all basically the same thing. I wish everybody'd use the same term. It would make it easier for everybody. But basically, it's your sales minus your cost of sales, and that'll give you your gross profit margin in dollars. Okay, so that's that number. Okay, then your accountant will get this information from your accounting system, all your expenses. If you use a spreadsheet, for example, some of you might do that. You decide you don't want to use an accounting system. They'll add up all the numbers on the spreadsheet, for example, for advertising, for accounting, for rental, all your different expenses. I've only put a list of about 10 or 12 expenses here, just so that I can have it on one screen. I don't want you to go back to your accountant and say, I went to a seminar today and they only had 10 or 12 different expenses. Depending on the nature of your business, you might have 20 different line items. You might have 5, or you might have 7, or you might have 22, whatever it is, depending on the nature of your business. But I'm going to try and keep this example very, very simple. Okay. So let's say last year, this business spent $34,585 on marketing. Its accounting fees were $1,500. It pays a rent of $24,000 a year. Okay. Its telephone account, and these numbers will typically not be rounded off, but I'm just going to round them up just to make it easy for me to calculate. My telephone was $1,200. My employee salaries last year, let's say, was $62,000. If this is a corporation and you took a salary as the owner, you would then put that in. So let's say you took a salary of $36,000. Let's say your insurance is $1,254, stationery $540, repairs and maintenance $6,547, and you'd go through every single expense. So basically, income statements are garbage in, garbage out. If you give your accountant garbage information, they're going to produce a garbage income statement. If you give them accurate information, they're going to produce an accurate income statement. So it's really important that you give them the correct numbers and you give them all the expenses. So some of you accountants will ask for invoices and receipts, and some of you, they'll ask for the information from your accounting system. For some of you, you'll use a spreadsheet, so they'll ask for a spreadsheet. Whatever system you use, doesn't matter. The most important thing is that you accumulate this information so that you can give it to your accountant at the end of the year. Okay? All right. So then we have a thing called depreciation, amortization. So as a business owner, when you buy assets for your business, those are not expenses. Okay, they're not expenses. They are items that you will use, equipment that you'll use for a few years. And what you can then do, or Revenue Canada allows you to do, is to depreciate those assets. Okay, and it depends on what the asset is, because every now and then small business owners will ask me, what's the depreciation rate for different assets? And I'll say to them, I don't like telling you, because every asset has a different, not every asset, but most assets have different depreciation rates. So often your accountant will ask you for a list of your assets, okay? And then they will calculate the rate for each one, and those depreciate every year, eventually to zero value, okay? So it's important that your accountant knows what assets you have, so that they can do a proper income statement for you. So there's an example of an income statement. It's got the revenue, it's got the cost of sales, It's got the gross profit margin. It's got all the expenses. And remember, yours are going to be different to mine. It's got the depreciation. If you've got any loans, you pay any interest on loans, it'll be in there. And then it'll show your profitability, okay? Or it could be a loss. Just remember that some years it'll be a loss. And that's okay, as long as you can explain why. I mean, some businesses, especially small businesses, over the last 2 or 3 years, some of them may make profit, but others have made a loss. And it's okay as long as you know the reason why. Okay, then your corporation will pay taxes on its profits. If you're in Ontario, the taxes are 12.2%. I had to think about that number, okay, on your corporation, and then you'll pay that over to Revenue Canada. So there's an example of a simple income statement. So there's a question here from Michelle. You said that cost of sales is opening inventory plus purchases of inventory minus closing inventory. Okay, so that's what I said. So I said opening inventory plus purchases minus closing inventory. Okay, so that's the way you work it out. So opening inventory plus purchases of inventory minus closing inventory. Okay, that's, if I said something different, that's what I meant. I apologize. All right, so let me just show you really important things that you can do now with the income statement. And actually, this is my favorite part of the income statement, because for me as a business owner, I want to see how am I doing. And I think this is key for you to understand, you know, how your business is doing. And the only way you can find out how your business is doing is by doing some calculations. So let me give you an example. So in here, we have a gross profit margin for last year of $172,049. So you as a business owner would have a logical question to ask. Is that good or is that bad? And that's the question you should ask your accountant, or you can do it yourself. So the profit margin for this business was 60%. How did I get that number? I took the gross profit in dollars, divided by revenue, and I came up with 60%. Okay, so 60% was the gross profit percentage of this business last year. So what can I do with that percentage? I can now compare that to other businesses. I can compare it to my business last year. I can compare it to my business over the last few years. And this is the big advantage of having that percentage. So without even knowing what revenue somebody else did, I can calculate how well I'm doing relative to them. And this is where it's really, really important. I call these ratios. You can call them whatever you like. I really don't mind. Sometimes we call them ratios. Sometimes we call them benchmarks. But basically, they're telling you based on the information, how are you doing? And I usually like measuring the most important ones in my business. So for me, a really important one is my gross profit margin. Okay, so that's an important one. Another important one I would measure would be my advertising and marketing, because in this case, you'll see it's a big amount. 12% of my sales goes towards advertising. The other one I'd measure would be salaries and wages. That would be a benchmark I'd measure. And I would compare these to my business in previous years, and I would compare them to other people in the industry. So this is why I want you to understand that the income statement not only tells you how did we do last year, it also tells you how did you do compared to other similar businesses and compared to your previous years. So it's a very, very good idea to get an accountant to help you with this. Why? Because they'll often have a few clients, hopefully similar to yours, that they can make comparisons to. And it's really important. For example, if some of you that live in Ontario will know that the supermarket profit margins have gone up quite a lot over the last 2 or 3 years, okay? And the figure they're talking about here is the gross profit margin. They're saying, oh, the profit margins of supermarkets have gone up. And you've heard in the media, they're saying they're taking advantage of consumers and things like that. But this often happens when we're going through stages of change in an economy, because what's happened is over the last 3 years, because of COVID, we had logistical problems and things like that, and the market is adjusting as we go along. Are some of the grocery stores taking a little bit of advantage? Absolutely. That's what they're doing. And the reason is because there's a couple of reasons. One, there was inflation, and now the prices are moving down, the cost prices, and the supermarkets are not moving down as fast as they could be. And again, I'm just making a general statement, just so you understand, where do people get this information from? How do they know that supermarkets are making more money? And this is the way they find out, by looking at the income statement, which they have to produce every quarter because they listed on the stock exchange. So there's a very simple income statement. So a lot of you that have been in business a while, your accountants produce this every year. That doesn't mean you've looked at it, but you produce this every year, and you pay income taxes on the profits here. If you make no profits, you don't pay any income taxes. If you make a profit, you pay income taxes. It's really not that complicated, okay? For a service business, it'll be quite similar too. Service business will be similar, but different. Again, remember, let's not worry about the expenses, because your accountant will put your expenses into your income statement. But let's say I was a consultant, or I was a business trainer like I am, something like that. My income statement would probably look like this. Let's say last year I made $78,520 of revenue. I have no cost to sale because I'm selling my time. Okay, so I have no cost to sell. I have revenue and I have expenses. So let's say I spent some money on advertising, $7,410 on advertising. My accounting fees were $1,500. I work from home, so I don't have a rent. Often your accountant will put an allowance for working from home. So speak to them about that, because it's an important allowance that Revenue Canada allows you to put in your income statement. And very often nowadays, a lot of us are working from home anyway. So Revenue Canada allows you to expense that. Let's say my telephone bill last year was $1,200. Let's say I don't have any employees. Let's say I'm incorporated, so I took a salary of $36,000. I have insurance of $541. I spend $854 of stationery. I have no repairs and maintenance. And let's say I've got some other expenses. We'll call them other expenses. I don't like calling things other expenses, but I'm going to do that now because I want to show you the basics. Okay. Then, because I'm a service business, my asset depreciation will be lower. Think of businesses like a nail salon or places like that. They've got equipment, but not massive amounts of equipment. So they would have depreciation, but not as big as a retail type business usually. Again, I'm generalizing, depending on the nature of the business. So let's say my depreciation last year was $1,250. Okay. So my profit last year before taxes was $26,511. Okay. Because I'm incorporated, I will pay taxes of 12.2% for last year. I think it's 12.2. I can't think of the number off the top of my head. Then this will be my profits after taxes. Okay, that's my profit after taxes, which typically small business owners will leave in a business, but also you can pay it out to the shareholders. Then they'll pay taxes on that. Okay, but that's basically what it looks like. This is what my income statement basically looks like. I mean, a few of those headings are a bit different, but that's basically what my income statement looks like. It's not that fancy. It's very simple. It's more or less the same every year, except the numbers might change. But the most important thing for me, again, are these percentages over here. As a business owner, I should be measuring these every year so that I know, how am I doing? How am I doing relative to last year? How am I doing relative to the last 3 years? How am I doing compared to my industry? Does anybody have any questions on that? On Thursday, we're going to discuss a little bit more specifics about financial statements. And if you've got any questions, I encourage you to bring them to the mastermind on Thursday. Marco was saying that last week he had a very good session because there were a lot of good questions. And I encourage you on Thursdays to bring your questions to those sessions, and I can help you. But here's the key thing I want you to understand, is that the income statement is really, really important. And you don't want to leave them too late in the year, okay? Because the longer you delay it, the worse it becomes. So let me just see what this question is. Do you add on EBITDA to operating expenses? Okay, so I'm going to explain to you what EBITDA is first. So EBITDA is earnings before interest, taxes, depreciation, and amortization. Okay, so in this case, it's this number over here. Okay, so it's this number over here. It's saying, what were your profits last year before depreciation? Okay, so that's what that is. Okay, so EBITDA is that. You don't add it to your expenses. It's a profit number. Okay, so it's a profit number. That's your revenue. That's your expenses. Your EBITDA is your profit. Your profit before taxes, before depreciation, before amortization. So often you will hear accountants, or you'll hear on shows like Dragon's Den and things like that, people speaking about EBITDA. Basically, that is the profit that the business has made on operations, okay? Operating the business, running. So basically revenue, in this case, revenue minus expenses, okay? Will give you EBITDA, just so you understand. All right, great question. So if anybody else has got questions like that. So Dawson's asked me, do you know who can work on one-on-one on Excel with you? I actually don't know, Dawson, but if I was you, I would go to something like Upwork or something like that and find somebody to do that for you. But I don't know anybody, to be honest with you. All right, Eldon says, if we are operating a business where our products are digital or services based, how do we calculate the inventory? Okay, so if you have a digital product and there's no cost of sale, you don't have a cost of sale, okay? You don't have inventory either. So for example, if this was a digital product, let's say I had a digital book, okay? I will call this digital products, okay? So that's what I will call it. Then every year I will spend money creation of digital products, okay? So creation of digital products. And again, this I would speak to my accountant about, because it's really, really important that they expense it properly in your income statement, okay? Because if you create digital products and you sell them over a few years, they may want to amortize them over a few years, but it's really important to do that, okay? So that's the way you would do it, because you don't have a cost of sales. Let's see if there's another question, yeah? All right, so that was the question. And again, here's the key thing, and I've said this, and hopefully I'm very, very clear, is you need an accountant to do this for you. I don't want you to be doing this yourself. I want you to get an accountant to do this, okay? And they will probably set up your income statement so that, for example, if you're selling digital products online, they'll expense that expense on creating digital products properly. And I think that's a really important thing that you understand, because they've got to understand the basic industry to be able to do that. So they've got to have a basic understanding of the industry to do that, okay? And then they'll perfect. There's no perfect way of creating an income statement, just so you know, but as long as it's consistent, that's the key thing. Because when you submit it to Revenue Canada or to any revenue agency anywhere in the world, they will analyze it, okay? So they will analyze that for you. How do you get the service ratios in column D? The way I get the service ratios, I take the expense, say advertising, and I divide by revenue. So I'll take advertising, divide by revenue. I'll take employee expenses, divide by revenue, okay? So the common denominator, if you remember math when you were in school, the common denominator is sales. So you take your expense divided by your sales, and that'll give you a ratio when you multiply by 100. So it's very simple math. There's no fancy math here. It's very, very simple math. That's the way you calculate the ratio. Divide the one number by the other, multiply by 100 to get your percentage. And in the case of an income statement, the common denominator, or the thing that you're dividing by each time, is the sales. So that's the common thing. So whatever expense I'm incurring, whether it's cost of sales, or if it's advertising or whatever, it's always divided by, and speak to your accountant about this, because you've got to understand that most of us on this webinar are paying an accountant every year to produce these financial statements anyway, okay? What we're not doing, and I'm just making an assumption here, what we're not doing is asking our accountant to explain it in a way that we understand. You know, for example, if you were in a food business, you know, is my gross profit margin good or bad? Is it too high? Is it too low? Is it average? All of those things you want to understand, okay? And then as you start understanding this more, you can monitor. I'll give you a very good example. So I don't know much about the restaurant business. And the reason I don't know it, I've never run a restaurant business, but I understand the basics. I used to own a business that used to supply restaurants and things like that. I've had a lot of people on my training programs that run restaurants, but I had one business owner, one of my training programs, and she said, she came into the class one day in quite a state. She asked me to spend a few minutes with her so that I could discuss her business. She was an engineer that had started a restaurant business. And she said, I'm not making any profit. I said to her, bring your income statement. Let me take a look at it. Okay. She brought me in her income statement. Even though I hadn't visited her business, I didn't know much about the restaurant business. I quickly showed her what she needed to do to improve her profitability. And there are basically very few things. Basically, you can either improve your gross profit margin or reduce your expenses. So when you know, for example, let's use a food example. Let's say my profit margin is 70% and the industry is 80%. Okay. So my accountant did a bit of research and found out that a business like mine should be doing 80%, I'm doing 70%. What options do I have? I can increase my selling prices. I can reduce my cost of sales. So those are the two things I can do immediately. So I need to know what can be done. So as a business owner, you need to know what your gross profit margin is. It's really important that you know for it. And your income statement will give you your average for your whole business. How do we calculate that? We take the gross profit in dollars divided by the sales. And that's how we get that percentage, okay? So you need to know what it is. If any of you use a point of sale system, you've got the advantage that you can even departmentalize it. So for example, if I ran a supermarket, and I don't, but if I ran a supermarket, I could calculate the gross profit margin in my bakery, in my deli, in my fruit and veg section, and they would give me an idea of how am I doing each department. And one of my goals would be, let's say, for example, and this is actually quite a good example, if I find that fruit and veg is the most profitable part of my business, well, maybe I should spend more time promoting fruit and veg in my business, which will in turn increase my average gross profit margin in my business, okay? So understanding gross profit margins is very, very important. But I know when I walk around, you know, visiting retail stores and things, I look at some of these businesses and I think to myself, the problem is not that you don't have a good business. The problem is that you don't understand the basics of financials, and this is why you struggle. So know your gross profit margin for your business overall, which comes from your income statement, and then for each department if you can. The other thing I would do is I would check it monthly. How do you do that? Your accounting system can help you do that, or your point of sale system. You've got to have numbers, and that's really the key. You've got to have numbers. I mean, you could do an income statement every month for your business. Let's say your business is struggling. You could do an income statement every month. Just take the revenue for last month, okay? That'll give you your revenue number. Take the opening inventory plus the purchase of inventory minus your closing inventory will give you a cost of sales. And then add up all your expenses, and that'll give you your profitability, or EBITDA, as we called it early on, earnings before interest, taxes, depreciation, and amortization. But that is a good enough number to know what is going on in your business, okay? So you could do it very simplistically every month. As long as you know what your opening inventory, your closing inventory are, you can do it. So, and if your business is struggling a little bit, I encourage you to do that, okay? The other thing I encourage you to do is to monitor your expense ratios. So how did I get those expense ratios? I took the total amount of the expense and I divided by the revenue. I did it both in the service business and a product business because the formula is the same, okay? But you've got to calculate that. Very easy. You can just take any one of you, if you have an income statement, you bring it to me, I'll put it on a spreadsheet, and in 2 minutes, we'd come up with the ratios, okay? And then we could analyze those. So somebody's asked me, what is the difference between an income statement and a P&L? Well, earlier on, I said that the income statement is often called the profit and loss or P&L. So they're the same thing. It's a different name for the same thing, which sometimes creates confusion. So good question there, Eldon, asking what is the difference between an income statement and a P&L? They're the same thing, okay? So it's just depending on who taught you, or what do you call it? I've always used the word income statement, but I know a lot of people call it the P&L statement or the profit and loss statement or the income and expense statement. Generally, in North America, we call it the income statement, okay? But again, I understand that sometimes it can be a little bit confusing. So you want to make sure that you monitor your ratios. The way you calculate your ratios, you take your expense in dollar amount, divide it by your revenue, and that'll give you a ratio, okay? The other thing you want to do is you want to set a net profit goal, because understand that you are in business to make profit, and you must never forget that. But only you know how much profit you need every year. The average business in North America does about a net profit of 10%, okay? So that's the average net profit. But some businesses do more. For example, we're in the service business, and we've always had a much higher than 10%. Again, because our revenue relative to a product business is not so high, okay? But we've always had a high number for net profit. And most years we achieve it, but not all years we achieve it. When we don't achieve it, we want to know why, what went wrong. And sometimes there's valid reasons. You know, maybe, for example, your cost of sales was higher. Maybe some of the expenses were higher. So maybe you spent a little bit extra on marketing or whatever, as long as you know the reason. And I think that's the key, is when you've had an unprofitable year and you know the reason, that's okay. When you have an unprofitable year and not sure why, that's where I have a problem, okay? Then what you want to be doing is you want to compare your ratios with other businesses. Again, this is where your accountant is very useful, because they will do the accounting for similar businesses. And if they do it for similar businesses, they could compare yours to theirs without even showing you what revenue these other businesses generate. They can tell you if your ratios are too high or too low, which is important. And you can compare yourself to yourself. So you can say, how did we do this year compared to last year? Okay. And these are the type of things we're doing. And I've been having this discussion with quite a few business owners lately and discussing, for example, increasing their prices. And the reason they've got to increase their prices is the input costs have gone up. Okay. So if you're a bakery, your flour, your eggs, those type of things have gone up. So you've got to make sure that you increase your selling prices. Is it very, very difficult? Okay. All right. So Eldon says, I noticed in the previous example that operating expenses included a 1% contribution to the number. Is this separate and distinct from the dividend payment? So Eldon, you're getting very complicated, but I'll explain to you anyway. Firstly, those numbers in that spreadsheet, as I was typing, I was just putting them in. Okay, that's what I was doing. I was not thinking, is this high, is this low? So that's the first thing I want you to understand. The second thing is, you speak about the owner's salary, okay? So the owner, if I'm incorporated, I can take a salary from my business, okay? Depending on where you are in the world, I don't know, but let me assume you're in Ontario. You can take a salary from your business. So you take a salary every month, and then every month you deduct Canada Pension Plan, and you deduct income taxes, and then the rest you take out, okay? So that's an expense for the business. Because as soon as you incorporate, you're an employee of the business. So my company, BizLaunch Media Inc., is a corporation, so I can take a salary from that, okay? All right, so let's say I take a salary that becomes an expense for the business, and let's say there's profits at the end of the year. Profits at the end of the year of $50,000. Now, I can decide as a business owner to either leave those profits in the business, or I can pay them out to myself. If I pay them out to myself, I pay dividend taxes, okay? So it's important that you understand that it depends on the way your company is structured. So Eldon, in my previous years, I used to take a salary out of BizLaunch. Now I don't take a salary, I only take a dividend. So that 1%, I don't even know what that ratio was, but let's say it was 1%. That 1% is no longer on my income statement because I don't take a salary anymore, I only take a dividend, okay? Hopefully that explains what it is. So that's an important decision you have with your accountant also. Should I take a salary every month or should I only take a dividend? And again, it depends on your situation. There's no one size fits all. And this is why I like business owners to have an accountant, because the truth is there's no one size fits all. I may take, for example, a salary every month and I'm incorporated, and I might not take a salary every month. It depends on my circumstances. Maybe if I've got a mortgage, I'll take a salary every month. If I don't have a mortgage, I won't take a salary, depending on your situation, okay? So hopefully that answers your question, Eldon. And if it doesn't, you can ask again. Is it good for your ratio supposed to be higher or lower? So that's a good question, Dawson. And the answer is your gross profit percentage, you want higher, and your expense ratios, ideally, they should be lower, okay? So that's a really good question, actually. So understand that your gross profit percentage or gross margin, you want to be a high percentage, and your expense ratios, ideally, you want them to be lower. Again, but it depends on your business, Dawson, but a great question. It depends on your business and what your expenses are. So those are great questions to ask, and you can ask me on Thursday again, specifics about your business, and I'll try and answer them. And I wish there was one size fits all, but there's not. In accounting, there's not one size fits all. Sometimes people will say to me, should I take a salary or should I take a dividend? And I say, it depends. It depends on a whole lot of things. Depends on the stage, depends on your age, depends on if you're going to reinvest, a whole lot of things. And this is why giving general information is quite a difficult thing to do. But looking at your scenario, I could explain to you if I was speaking to you one-on-one, which I won't do because I'm not an accountant. You need to get an accountant to explain to you. So for retailers, one of the things that, let's say you want to become a little bit more sophisticated, you can use your point of sale system to give you data. And data can be really useful in your business. For example, sales by category, you could get out of a POS system. Sales per square foot, you could get out. I know, for example, when I was in retail, we used to calculate sales per square foot. And because square footage is very, very expensive. So if you're not getting the sales out of a square footage or space, you want to remove that product. So maybe some of you've heard the story. Small business owners make a product, get it onto the shelves of the supermarkets. And they all get excited, my product is on the shelf. And what happens sometimes, it's very successful, but other times it doesn't get the sales volume that the retailer wants. What does the retailer do? Discontinues the product. Okay, so that's the reason they would do it. It's based on data, not on, I don't like that product or I don't like that person. The other thing you should calculate as a business owner is your average sale per customer. And let's just think of what are we going through now. I don't think we're in a recession yet, but we're leading into a recession. I heard earlier on Powell speaking about the interest rates, and he was saying that he's going to probably increase them much more than he expected. So basically, what is that saying is that they want us to go into a recession, basically. And what happens, not all businesses, but what happens when we go into a recession is often people will buy less. If people buy less, our average sales per customer comes down. If we know that, we can do something about it. What can we do? We can upsell, we can train our employees, we can do all of those things. So having data is very, very useful as a business owner. And I want you to understand, if I could help Main Street retailers, that is one thing I would spend time with them, is spend time analyzing the income statement, analyzing the data, and identifying why they're not as profitable as they want to be. And it's not difficult to do once you have the data. If you don't have the data, it's very, very difficult. So sometimes people say to me, what do you think about my idea? And I say, well, firstly, I don't think about your idea. And secondly, without data, I can't tell you whether your ideas are worth pursuing but with your income statement, I could easily tell any one of you on this webinar, you said, if I looked at your income statement, I could tell you whether your business is worth pursuing or what you need to do to ensure your business becomes profitable. And that's the advantage of data, is once you have data, it's very easy to give a business owner advice. The other thing you want to do in retail is, for example, identify prominent spaces that increase your profitability. So here's a question. As a medical professional operating a therapy clinic, where would I find profitability and performance comparables? Is this something only an accountant can provide? Okay, so depending on the nature of your business, and in this example, I don't know anything about medical professionals, but I've got a feeling I know that if I was in that industry, I would speak to my accountant. That's one place I would get some ratios and to know if I'm doing okay. And usually there's associations. For example, let's say I was a naturopathic doctor, as an example. I could speak to the Association of Naturopathic Doctors and ask them, what is the average for my industry? Okay, if they collect the data, if that association doesn't collect the data, you can't tell, okay? So basically, it doesn't matter what your industry is. If there are other people in the industry that they can make comparisons again, you can make, but sometimes there's not. Like my industry actually is a very good example. Mine is not an industry. I run seminars and training programs and things like that. There's not many people that do this as a full-time job. So I could compare myself to other service businesses that are not specific, and that's one of these strategies I could use, okay? But to compare myself to other similar businesses, there aren't any. So those are some of the things that you have, especially if you're a very niche industry. But most industries have got published ratios. Actually, if you went onto the internet tomorrow and typed in ratios or benchmarks for my business, Google would find something for you. So one of the ways we do it in retail is we use prominent in-store places to attract more profitable products. So you will see, for example, when you go to your Walmart or anything like that, they have candy at the counter. And why do they have candy at the counter? Because while you're waiting for the cashier, they want you to pick up that candy, put it in your basket, and that improves their profit margins, okay? So all of those things are very strategic. So merchandising can be very strategic. I know when I was a retailer, merchandising was very strategic for me because I knew that if I was selling a low margin product and put a high margin product next to it, the chances of a customer taking both would improve my profitability, okay? So you've got to understand that. Or McDonald's, for example, you'll go in for a burger, they'll offer you the fries. And the idea is the margins on fries are higher than burgers, and that's why they do that. Train your employees to upsell products, which is a very, very good strategy. And again, these are things when you have data. So when you have data and you see, for example, that your profit margins are too low, you can do something about it. Train your employees, get more accounting advice, maybe speak to a consultant, whatever it is. How do we increase our profitability? Firstly, charge more. Again, I know some of you can't charge more. Well, then if you can't charge more, then you have to try and reduce your expenses other ways, or you're going to make less profit. There's no other way of doing it. So most of us, including myself, have increased our hourly rates over the last 2 or 3 years. And that's been good for my business because the hourly rates were quite static for quite a long time, or daily rate is the way we charge. Focus on moving fast-moving profitable items. But the idea here is you've got to know what those are before you can promote them. Don't discount. And I think this is very, very important that you understand this. Always think of discount as giving away your profit, because that's exactly what it is. If you're going to run a promotion, The way we do it in retail is we calculate what sales do we need to generate to make the same profit. So understand that is if I discount something by 10%, how much more revenue or how many more of these things do I need to sell to be able to justify? So don't discount for the sake of discount. Discount with the intention of either making the same profit or more profit. And that's your objective, okay? Because sometimes that happens in certain businesses. I know I was in retail for many years, and we run a promotion and we do massive volumes of the product. So even though we reduced our profitability in dollar amounts, okay, per product, overall we made more profit. But again, it's a dangerous game if you're not measuring things. If you're measuring things, I'm okay. The other thing you can do is reduce waste and shrinkage. You know, there's a lot of waste in businesses. And again, you've got to learn to understand what's causing that waste, okay? If you really want to get specific, I'll teach you a method of calculating what your waste is in your business. What you do is you do a profit margin projection. So you say, based on my costs and my selling prices, my profit margin should be, say, 70%. When you do your income statement at the end of the year, if it comes out at 68%, that 2% is your shrinkage and wastage, okay? But again, it's very precise if you're collecting data properly, if you're managing your gross profit margins properly, all of these things. And this is a topic on its own. I could spend hours and hours discussing this, only because I was a retailer for many years and very successful eventually, not in the beginning, but I learned these things over time, the importance of, you know, when you first start a business, you get all excited about selling stuff. Eventually, I want you to get excited about selling stuff at a profit, which is the key. The other thing you want to do is you want to train your employees to be more productive, because that ratio is quite a big one. You can see, for example, if any of you been watching the news, most of these tech companies have been laying off people. And the reason they're laying off people is that probably next year, depends on how long this takes, they will become very profitable. And then they'll probably start employing people again. But the key thing you got to understand, that is one of the easiest ways to increase the profitability of a business. It can also be bad for a business, but that's what you want to be doing. And you can measure productivity. And the way you measure productivity is on your income statement. So that's the way you do it. If you're going to pay people bonuses, pay it on profit rather than just sales. I see a lot of businesses paying commissions or bonuses based on sales, which I think is a dangerous game, because there's a combination of things that make your business profit, not just the sale. Sell added value by bundling. That's one of these strategies a lot of the tech phone companies use. You'll buy a phone and then they'll sell you internet service and they'll sell you whatever, TV service and things like that. So the bundling is the way they make the profit. It increases the sale per customer and increases the profitability too. And then focus on marketing to profitable customers. And I think this is a very, very important thing. I was saying this yesterday to a business owner. She's an architect. And I said to her, I want you to find your favorite customers, which are the easiest to deal with and the most profitable. And I said, when you find those, I want you to find more of those. And it sounds very simplistic, but that is how things work in business, is when you know which customers make you the most profit and you can supply better than anybody else, you want to focus on those. When it comes to increasing your sales as a business owner, there are a couple of really important things. One of them, keeping your best sellers in stock. You know, sometimes businesses go out of business because they just don't have the right inventory, and that is a problem. Increase your average sale per customer. So educate your employees, and if you're the only person, just learn how to upsell. And you've seen it. You've gone to Starbucks, you get to the counter, they try and sell you one of those cookies or whatever it is. Increase the number of items people buy. So make sure that when people come into your store, you know, the merchandising is appealing and encourages people to buy. then increase the number of customers. These are basically the things you want to be doing, is you want to work on these things, because once you got the revenue right, then you can tweak it to get the profitability right. All right, so earlier on, I was saying that at the end of the year, your accountant produces two statements for you, the income statement and the balance sheet. So now we're going to discuss the balance sheet. Eldon says, a question about forecasting. How does the income statement relate to financial projections and modeling? Okay, so if I was doing a financial projection for 2023, for example, I would look at 2022. I'd look at my income statement from last year and say, okay, last year we generated $172,000 of revenue, and then I project forward, okay? And usually I would try and get at least inflation rate, but usually more. Okay, so you use your income statement to do sales projections, and you can use it to create a budget for your business in the new year. Okay, so that's one of the ones you can use it for. So to do sales projections, to do expense prediction, to create budgets, all of that information you can use your income statement for. Why? Because it's historic information. It's accurate historic information saying this is how much we spent last year. So in most large corporations and small businesses, what they will do is they will take last year's numbers and project forward. Or there's another method they use, it's called zero-based budgeting. Zero-based budgeting means that you start from scratch again. You don't look at last year's numbers, you say, okay, what are we going to do this year? Okay, Eldon, so that's two ways you do it, either based on previous year's numbers, or you can do zero-based budgeting. How many years of income statements do you need before you can make an accurate projection? The truth is, it depends on the nature of the business. It really depends on the nature of the business. But I would say to you, between 3 and 5, you can become very, very accurate. I know, for example, because I've been in my business for 20 years, I can quite accurately project what's going to happen in the future. Do I some years make mistakes? Absolutely, because there are different scenarios you can't plan for. For example, when COVID started, nobody could project for that. So forecasting is as good as, depending on, there's no weird situations that happen. But basically, forecasting is based on previous year's numbers. And the more years you have, the more accurate you're going to be. Okay. So usually 3 to 5, I would say, isn't a good example. But I mean, I know, for example, in the franchise industry that I was involved in for many years, we do 5-year projections on brand new stores. Why? We had enough data to be able to project reasonably accurate. Was it always correct? Absolutely not. But often we could do 5-year projections. I mean, your banks will often ask for 3-year projections at least. But again, projections are as good as the data you have and the knowledge you have about the industry going forward. At the moment, I think there's a lot of unknowns. I must be honest, there's a lot of unknowns. And if any of you own shares in the stock exchange, you've heard companies saying, we can't project what's going to happen in 2023. Why? We don't know what the interest rate's going to be. We don't know what the inflation rate's going to be. So there's a lot of unknowns, a difficult time to do projections. All right. So now let's speak about the balance sheet. The balance sheet is the second financial statement that you send through to Revenue Canada or your revenue agency. Your accountant's going to produce this for you, and they're going to send it through. And on this balance sheet, it's got all the business's assets and all the business's liabilities. So all the things that the business owns and all the things that the business owes, okay? And basically it calculates your net worth. So if you wanted to calculate what is your net worth of your business, you take your assets minus your liabilities, and that'll give you your net worth, okay? So on a balance sheet, you typically have on the one side, you have all the assets, and on the other side, you have the liabilities and the net worth. And that we call the accounting equation, okay? So what assets do you have in your business? What liabilities do you have in your business? And that'll give you a net worth. If you have no liabilities, that's a big advantage, especially in this economy. People that don't own a mortgage, don't have lines of credit, aren't using credit cards, are not sailing, but they're better off than the people that have all these liabilities. And the same thing for businesses. Businesses that don't owe money are not too concerned about the interest rates. They're more concerned about the rate of inflation, but they're not concerned about the interest rate. If you're a business that has big loans, this is a problem for you. because your EBITDA may stay the same. If you want to use fancy words, your profit before depreciation and amortization will be the same, but then your expense percentages have gone up. Okay, so your amounts on loans, so maybe your EBITDA, your operating profit will be good, but your net profit will come down because of the interest rates. Do you understand? And this is why, one of the reasons, not why, but one of the reasons, for example, companies on the stock exchange have been doing badly is because they owe a lot of money. Because they owe a lot of money, that's going to reduce their net profit, not the EBITDA, but it's going to reduce their net profit. Anyway, I just thought of that actually as I was speaking, only because somebody asked about EBITDA earlier on, because I don't typically speak about it on my webinars, but there was a good example of how you could use it. All right, so what I'm going to do now is I'm going to show you what a balance sheet looks like. Yeah, the first thing I want you to understand, when your accountant produces your balance sheet, they probably won't use colors like I used. They probably, it'll look a little bit different. Usually you'll have assets at the top and you'll have liabilities at the bottom, okay? So that's usually what it'll look like. It'll have the assets and the liabilities like that. The only reason I did it like this was so that you can see it on the screen, okay? So if you go to your accountant and say, you know what, I saw a balance sheet today in a class and it was green and it had headings highlighted and things like that, they're going to say, no, that guy doesn't know what he was talking about. Okay, so just so you understand. Only reason I do it like this is so I can explain it more explicitly. Right, so at the end of the year, your accountant's going to do a balance sheet for you. If your year end is the 31st of December, it'll say, as at the 31st of December, 2022, this is this company's balance sheet, okay? The first thing your accountant will always ask you for, and some of you that have accountants, you know exactly what I'm talking about. Your accountant says to you, give me your last bank statement for the end of last year so that I can get the bank balance. And they'll enter that number there. That's where they'll enter that number, okay? So it's an actual number. It's not a guess. It's not a maybe. It's an actual number that they get from your bank balance. Then your accountant is going to ask you if you sell on credit, and most of you, I'm going to assume, don't, but your accountant's going to ask you. They're going to say, who owes you money? So basically, these are invoices that you've invoiced for during the year that haven't been paid. They're going to ask you for that number. They're going to put it into the accounts receivable. Then your accountant's going to ask you, what's your inventory? And it's important to know what this number is, okay? Because they can then do your income statement. So you've got to actually physically count all the inventory in your business at cost, and you've got to give it to your accountant, and they'll put it into your balance sheet. So this is why sometimes balance sheets and income statements aren't accurate, is because the small business owner doesn't give this information to the accountant. And if they don't give the information, there's no way you can do it properly, just so you understand. Okay, so you've got your bank balance, you've got your accounts receivable, you've got your inventory. Those we call current assets, okay? That's the term that accountants typically use, and that's the term I'm using now. Then we get a total for that, which we call total current assets. Then we've got long-term assets, okay? These will be in the business a few years. A bank balance changes basically every day. Your accounts receivable change quite regularly. Your inventory changes probably every day. So this is why they call these current. And then we've got long-term assets. These could be, for example, long-term investments. So maybe you've purchased some shares or you've purchased some real estate in your corporation that would go into balance sheet, okay? Then you would have your fixed assets. This is your machinery, your equipment, those type of things, depending on the nature of your business. If you're a regular retail business, all that equipment that you use every year to run your business, we call those fixed assets. Those fixed assets are depreciated every year. Remember, different percentages. This is why it's really important that you give your accountant a list of all your assets, then they can calculate your depreciation, okay? So then you have current assets, and you have fixed assets, And those will give you your total assets. Made a little mistake here. Wonderful. Wonderful. I'm glad I saw this here. Anyway, so you got long-term assets plus your current assets, and that'll give you total assets. Okay. So this is the number in your balance sheet. Do we understand? All right. Then you've got liabilities. Remember, the accounting equation is assets is equal to liabilities and owner's equity. Okay. All right. So then your accountant's going to ask you for your accounts payable. So this is very, very important. At the end of the year, your accountant wants to know, who do you owe money to? You add up those invoices, you send it to your accountant, okay? Or it'll be in your accounting system. Do you have any lines of credit? And that'll typically be lines of credit, okay? Your line of credit, you'll get this amount on the last day of the year. So maybe you'll phone your bank manager and ask him, or you just check the statement, okay? If you owe any income taxes, they'll put it in there. If you owe any salaries and wages, they'll put it in there. Okay, so these are the current liabilities. What does current liability mean? That this changes on a regular basis. Okay, so that's the easiest way to explain what current liabilities are. Then you've got long-term liabilities, things like a mortgage, or if you owe anybody money over a few years, you'd include in that. So these are the things that the business owns. These are the things that the business owes. Okay, and then we have a section called owner's equity, which is the amount of business money the owner invested in the business, plus any profits that the owner keeps in the business. So at the end of the year, if you've got profit in your business and you don't pay it out to the shareholders, we put that in the balance sheet on retained earnings. Okay, that's where we put that. If you pay it out, obviously it's got paid out. It is not retained by the business. So that's what a balance sheet is. It's very, very important. So here's a question for inventory. Do I count it at the regular value or the retail value at cost? Retail value with markup. No, Dawson, your inventory is at cost, which is really, really important. Your inventory is at cost. So understand that. That's the accurate way to put it into your balance sheet is inventory at cost. That's why your accountant will ask you to do that. So I want you to understand that the balance sheet is very, very important that your accountant produces it. But who else wants a balance sheet? Typically, your banker will ask for a balance sheet. Why? When they lend you money, they want to know what the risks are. So for example, this is what they want. They want to know, do you have enough money to pay this loan? Okay, that's the one question. The second one is, if you go bankrupt, will we get our money back? Do you have assets to sell? And thirdly, what does the owner have to lose? Do you understand why the balance sheet is important for the bank? And this is why they ask you for it, because it tells them what are the things that the business owns and what are the things that the business owes. So is it liquid is the word we use. Is it not bankrupt? All right, so some of the things that banks measure or financial people measure is the liquidity of the business. So basically, can this business afford to survive? Okay, and these are things that are really important for bankers, but also if you're selling your business. So one of the things that the bankers will calculate are your current assets divided by your current liabilities. We call that a current ratio. So basically, if your banks recalled your line of credit tomorrow, would you have enough money to cover that? That's basically what it means in the most simplistic terms, okay? The other thing we'd measure is inventory turns. So for example, I want to know how often your inventory turns every year, okay? So, and usually you can get an industry average. So certain businesses will have high inventory turns, like a supermarket will have a high inventory return, whereas a furniture store or a gift store will have low inventory turns. But the point is, you want to know if that number is going up, going down. Let's say that number is going down. So I've got a business and my number of inventory turns is going down. What that means, even though I could be profitable, that my cash is tied up in inventory, which is a problem, or could be a problem, depending on how much cash you have. So that helps you identify what the problem is. So if I compare last year to this year, that could be one of the reasons I have a cash flow problem. The other thing that businesses or people, accountants, people like me, bankers will want to know is your debt ratio. So what are your total assets? What are your total liabilities? If we had to liquidate all those assets you have in your business, okay, could we pay all your liabilities? The answer is yes, that's a good thing. The answer is no, we have a problem, okay? So that's what they do. The third financial statement you need to work on is one that you do yourself. So earlier on, I can't remember who it was, said, how do you do projections? And they used the term financial modeling and things like that. So let me explain to you what they were talking about. So every year as a business owner, what you should do, and I know some of you don't do it, but what you should do, and I do this every year and I teach all my business owners to do it, is to do a forecast. So we call these cash flow forecasts, okay? And what it is the sales we expect to make. I mean, this you could even make more fancy. Let's say I was doing a January to December. I would put in the months and then I'd do a sales forecast. Where did I get these numbers from? I would look at last year and project forward, okay? Or even better, I would break up the numbers. I departmentalize numbers. That's the way I like doing it, but I thought I'd just keep it simple for this webinar. So you have your sales forecast, and then you have your cash inflow. So when is money flowing in? If you're a retailer, most of your sales will be for cash or credit card or whatever. So they come in on a regular basis. So cash flow is important for you. But if you're selling on 7 days or 30 days, like my business, for example, I will do project now and not get fully paid until the end of the project. So cash flow is really, really important for me. So I've got to plan it. But again, it depends on the nature of your business. Okay. And then you will do an expense forecast. Where will you get the numbers for this expense forecast? You'll get it from last year's income statement or last year's accounting system or last year's information that you have. You take that and you project forward. That's the way you do it. So this is why when you go to the bank to get a bank loan, they'll ask you for a cash flow forecast for the next 3 years. So what they're asking you for is to forecast what's going to happen in your business over the next 3 years. How much money is going to flow into your business and how much money is going to flow out of your business. And more importantly than anything is how you're going to repay us. Do you have enough money flowing into your business to be able to repay this loan? That is the thing that banks want to know. It's really, really important to them because you've got to understand that cash flow. So even though you've got this beautiful income statement with lots of profit, cash flow could be your downfall in business. And what causes cash flow problem? Things like your customers paying late if you're selling on terms. Things like too much inventory. Things like that create cash flow problems. So you've got to understand that a combination of the financial statements will give me details. The income statement will tell me how profitable your business is. The balance sheet will tell me how liquid your business is. And also, if you're turning your inventory reasonable for your industry, okay? Your cash flow will tell me, do you have enough money to pay for all these expenses and debts that you have? And here's the thing that I always say to small business owners. The number one reason that small business owners fail is because of cash flow. So you cannot ignore the financial statements in a business. Say, well, that's not really my thing. It has to become your thing. You have no option, has to become your thing. It's your responsibility. And the reason it's your responsibility, you can have a good P&L account or profit and loss account or income statement, whichever we're going to call it, and still have a cash flow problem. So understand that. So let me just summarize, and then I'll leave a few minutes for questions. But just remember, Thursday, if you've got more questions, bring them to the class, hard ones, soft ones, complicated ones, specific ones, bring them on Thursday to this webinar, and I'll try and answer as many of them as possible. Actually, some of the questions today were unusual questions for me. I don't always get questions like that, but good ones. If I understand it, I can explain it to you. I don't always understand all these things. So the key thing I want to get across today is that you have no option as a business owner. You have no option. You've got to understand the two financial statements, mainly the income statement, but basically the balance sheet too. Your accountant's got to be able to explain it to it. And then you've got to understand cash flow, because cash flow is your responsibility. Your accountant at the end of the year will create the financial statements, send it through to Revenue Canada, which you pay taxes on, but it's based on history. That's what it is. Your bank wants to know history and the future, and that's why they ask you for a cash flow forecast. So you've got to have a basic understanding of the financial statements, okay? That the income statement shows the profitability of the business, the balance sheet shows the assets and liabilities of the business, and that the cash flow does a projection of the future inflows and outflows of your business. So you've got to understand those basics, because then you can ask questions. You can go to your accountant and say, how do we improve our profitability? How do we improve our stock turns? How do we improve our liquidity? Should I take a dividend this year? Shouldn't I take a dividend? Should I borrow money? Shouldn't I borrow money? If I borrow money, how much should I borrow? All of those things are very important. What happens often with business owners, we're doing things blindly. We're asking for money with no idea how much we need. Analyze your income statement. At the end of every year, sit down with your accountant and just say to them, how did we do compared to last year, compared to other businesses? And this will make you a better business owner, because then you can work out, what do I need to do to improve? If I need to improve my profitability, I either need to increase my selling prices or reduce my cost prices. That's what I need to do. Or I need to re-merchandise my store so I sell more profitable products. Understand and manage your balance sheet. Your balance sheet, you should sit down and discuss with your accountant. They will give you ideas of what you can do to improve your not your profitability, but the assets you own in your business. Because if you want to sell your business, they will look at your balance sheet, and so will your accountant. Your banker, if you're going to sell your business, or if you're going to borrow money. Know what your break-even sales is. Okay, so how much sales do I need to generate every month for all the outflows of money out of my business? For a retail business, you take your fixed expenses divided by your profit, okay? Your gross profit margin. If you're a service business, you take your fixed expenses and divide by your hourly rate if you charge by the hour, or daily rate, whatever you charge, that's the way you calculate. But here's the most important thing, I think, when it comes to financial statements. None of us are experts at this. Not me, or maybe you are, but I'm not an expert at this. I'm learning things all the time. So even though I run these seminars, I run these webinars, I'm learning things all the time, firstly. Second thing, when it comes to financials, things are changing all the time. The interest rates change, the tax rates change, whether you should take a salary or dividend changes. So I think it's very, very important that you have a basic understanding how this works, and then you can have a discussion with your accountant, and then you can work out the best possible way for you. Because here's the truth. You have to pay income taxes. There's no way out of it. Actually, I like paying income taxes because it means that I had a profitable year. But as a business owner, I want to pay a fair amount of taxes. I don't want to overpay because I didn't manage the way I took money out of my business properly, or because I took too much of a salary, which increased my tax liability, all those different things. These are things you can manage. So you will learn over time and learn from experts. Don't listen to people, that are in the pub and telling you this and that. Listen to experts. A lot of people know a whole lot of things that are totally irrelevant, and it's usually because they're not experts in their fields. Barbara says, how do I calculate BE? I'm going to assume that that's break even. You take your fixed expenses, you divide by your gross profit margin percentage. If you retail, if you service business, you take your fixed expenses, you divide by your hourly rate or whatever you charge, and that's the way you calculate your break even. Or here's another way you can do it. You take your income statement, okay? You take your operating expenses for your business, and you can include your depreciation if you want to, and then you divide by the profit margin, which is the average profit margin, which is on your income statement. So that's the way you can do it. See how relevant this income statement is? It's very important. Ask your accountant, they'll help you with it, and they'll give you a number. Will these slides and templates be shared after the training? It will be helpful. I will send the slides through to Chris, and then if any of you want to get them, you can get them from Chris. Let me just remind you that all of these webinars are recorded, and then we post them on the My Main Street website, okay? So you can go back and you can watch these again. And I can't encourage you to do it. I mean, I get asked that question all the time. After a webinar, people say to me, where can I get a recording? And I say it's on the My Main Street website, okay? But what I'll do after this webinar, I will make a copy of these slides and the templates, and I will send them through to Chris, and then you can get it. You've got Chris's email, because when you're registered, he sends you the registration link. Any other questions anybody has? There you go. There's Chris's email in the chat. If you just go to see the chat, you've got Chris's email. He'll send you the slides. And if I forget, which I don't often do, but if I forget, Chris will remind me and say, Andrew, you said you were going to send through the slides and the templates. I will send them through, and then you can do that. Just remember, I encourage you to come on Thursday. If any of you have got any questions you want to ask, on Thursday, same time, same place, from 2 till 3, I will discuss some of your questions. So Dawson's got one question here, and then we're going to end off the webinar. When it comes to spending money for my business, I'm very frugal, which is very, very good. When you make decisions, do you use a pros and cons chart? That's a really good question. And here's the decision that I make as a business owner. This money that I'm going to spend, is it going to generate more revenue? If the answer is yes, then I spend it. If the answer is no, then I don't spend it. So I suppose you could call it a pros and cons chart if you want to, but that's the way I make a decision. And let me say something, Dawson, being frugal is very, very good. I'm also very, very frugal. What you've got to be very careful of, which is my problem, is sometimes I'm too frugal. So just be very careful of that. But I've learned over the years, especially with stuff for my business. You know, we do a lot of online learning, videos, and all that type of stuff. I always invest in the best possible equipment I can buy for our content. And that's really helped us over the years. But that's not where I started. When I first started my business, I started with used equipment and stuff, and that worked wonderfully. So being frugal, not a bad thing at all, Dawson. Don't stop being frugal. But again, when you make the decision about spending money, especially in this economy, is will it make more profit for the business? Will it make more revenue for the business? That's the way you should make the decision. And if the pros and cons chart works for you, absolutely do that. And it works. I usually say to people, whatever works for you. All of us have got different ways of doing things, and it works for us. All right. Thank you very much, everyone. Thank you for attending this afternoon. Hopefully, I taught you at least 1 or 2 things that you can use straight away in your business. But here's the thing. This stuff only works when you use it. So make an appointment with your accountant. Tell them you went to a seminar today, and this guy said, I should be measuring all the ratios, and based on the ratios, I can make decisions about improving the profitability of my business. And that's what I encourage you to do, is to do that, is go and get yourself involved. You're paying for the service anyway. You're paying your accountant. They understand this stuff. They can help you grow your business. Times are tough. There's lots of difficult things going on in the economy that make it challenging for small business. So the more advice and guidance we can get, the better it is. Have a great afternoon, and I'll see you on Thursday. Thank you very much, everyone.